Let me start by clearing something up. This is not a crypto pitch. It's not futurism either. And it's definitely not about turning oil, gas, or power into software. This is about something far more mundane and far more important. Capital. Specifically, the way capital still moves through the commodities markets, moves slowly, manually, and expensively, and how all that is finally beginning to change. I spent more than 2 decades inside commodities, trading floors, operations, risk committees, balance sheets where mistakes don't get rebranded, they get paid for. In parallel, I spent the last decade inside digital assets, not observing them, building them, operating them, stress testing systems where capital moves at machine speed and settles instantly. Those two worlds barely ever spoke to each other. When they did, it was mostly noise. Usually for people who hadn't taken risks in either. That separation is now ending, not because it's fashionable, because the capital plumbing underneath the commodities market is no longer fit for purpose, and pretending otherwise has quietly become very expensive. So, let's be precise here. This is not about putting physical commodities on-chain. Oil does not need to become a token. Gas does not need to live on the blockchain. And power does not need to turn into software. Commodities already work. They're global, they're liquid, they're regulated, ruthlessly efficient at what they do. What doesn't work, however, is a capital that moves underneath them. Settlement delays, manual reconciliation, document-heavy controls, and balance sheet-intensive financing, all built on trust built over decades instead of visibility in real time. Most commodity firms don't have a technology problem. They have a capital coordination problem they've been politely calling operations for years. And here's the key distinction. The opportunity is not tokenizing barrels, molecules, electrons, or bushels. The opportunity is tokenizing the claims, the obligations, the collateral, and the cash flows that already exist and already trade, but do so slowly, expensively, and with unnecessary friction. This is where on-chain infrastructure actually matters. When designed properly, on-chain does not mean chaos. It does not mean loss of control. It means state ownership, collateral, settlement, margin, and compliance, represented in a shared system that updates continuously. Not once the spreadsheet catches up 2 weeks later. Capital becomes programmable, escrows become automatic, and collateral becomes mobile, and risk stops being debated after the fact. That's not disruption, that's overdue maintenance. Now, let's talk about why this actually matters. Because the pressure on commodity markets today is not cyclical, it's structural. Capital is more expensive, we know that. Bank balance sheets are tighter. Settlement cycles increasingly look medieval, and regulators have developed a sudden allergic reaction to being transparent. At the same time, demands on commodity firms keep rising. More margin, more reporting, more compliance, more liquidity buffers. For decades, banks absorbed this friction. They financed the gap between trade date, shipment, inspection, invoicing, and payment. That generosity is quietly being withdrawn. And here's the uncomfortable truth. If your business model depends on settlement delays to survive, your operating model is old-fashioned. Meanwhile, digital assets infrastructure has grown up. Stablecoins now function as credible settlement rails. Tokenized collateral can be monetized continuously. Programmable escrow actually works. Audit trails are live, and controls exist that would embarrass most legacy systems today. On-chain infrastructure allows capital to settle, margin, and audit continuously. Traditional systems were never designed to do that. Not because they were built badly, but because they were built for a completely different era. The two worlds are now compatible, not because crypto won, but because commodities ran out of excuses. So, how does this actually unfold in the real world? It doesn't unfold overnight, not all at once either, and not the way market decks suggest. This transition happens commodity by commodity. Oil, gas, power, metals, agriculture. All of it, one by one, will happen. Each with its own supply chain, its own risk profile, its own capital dynamics. The discipline is always the same. Who is actually involved? What is really being traded? and how money and risk move today, where friction genuinely lives, and where tokenized stablecoins and programmable finances fit, step by step. Some structures work early, some take years, but anyone promising otherwise is trying to sell you something. Because institutions, they don't leap, they migrate, quietly, selectively, starting with capital, never cargo. So let me end it like this. This is not a call for action, it's a statement of direction. Commodity markets will not wake up one morning on-chain. They will move gradually, beginning with settlement, collateral, and financing. The first firms that do this properly will not talk about blockchains. They will talk about faster settlement, lower cost of capital, cleaner risk, having stronger control. Everyone else will say it feels unfair. On-chain is not the destination. It's the coordination layer commodities never had, and now they can't avoid it. Tokenization does not reward vision statements. It rewards execution. It rewards discipline and the ability to operate on both sides of the bridge. If you skim this, you'll completely miss the point. If you dismiss this, capital will quietly become more expensive around you. But if you understand it early, you'll recognize the advantages when it happens. This isn't the future. It's the part of the present that most people haven't caught up with yet. Next comes oil.